Thank you, everyone, for joining us today. I'm Eric Torgerson, in case you didn't know, and we're here to hear about a project from Birchwood Healthcare Partners. We're very excited about it over at ET Capital Partners. This is the first fund we have represented, so it's something new for us. So I'm very excited to hear what they have to say about it because I'm going to be learning about it also. We have Bill Brennan with us from Birchwood, and we also have Sean McNee. So they will be going over the project and several projects that will be included in the fund. So I will give it to them.
Excellent. Well, Eric, really appreciate the opportunity to have this web call. For those of you that are joining this call, I was actually in Des Moines a couple of weeks ago for the Learning and Libations event that Eric had hosted at his office in Des Moines, and it was just a great opportunity to meet a lot of you potentially that are on this recording face to face. So thanks again for the opportunity. And with that, before I jump into the presentation, I just wanted to provide a bit of an agenda of things that we'll talk about. My name is Bill Brennan, Senior Vice President of Investor Relations here at Birchwood Healthcare Partners. And as Eric mentioned, joining me is my colleague, Sean McNee, who is our SVP of Acquisitions at Birchwood. What we're going to talk about is our fund. We recently launched our 5E Plus Seniors Healthcare Fund in 2023. It's a $100 million fund, and we're excited that we're approaching our second close of the fund as we've made a couple of acquisitions. We've built a robust pipeline of opportunities, and we're excited to share the update with you as far as some of the investment opportunities that you would have access to by investing in this strategy. What we'll also talk about is the demographic trends of seniors. I'm sure you read a lot about the silver tsunami. We'll talk about that. We'll talk about market dynamics. There's been a lot of distress in the senior space. And coming out of COVID, we see just a lot of great investment opportunities, which leads me to the third point, is deployment of capital. We think now is just a great time to be deploying capital, and we'll talk to our investment pipeline as to where we're finding the best opportunities. And then lastly, we have a lot of boots on the ground in Iowa, specifically in the Des Moines metro area. Our in-house operator, Campbell Street Services, has a huge presence in the Des Moines metro area. And I'll talk a little bit about Campbell Street Services. We're rebranding to Campbell Street Senior Living. So you'll see that on the slides. And then, of course, Eric, I think you'll ask some questions, and we'll have some Q&A. So let's just jump right into it. So Birchwood, we are a Chicago-based investment firm. We're celebrating 10 years of being in business. We are an owner, operator, and investor in senior healthcare facilities. I think what you'll get out of this presentation is that we're a fully integrated and diversified investment firm. We serve over 2,000 residents and patients across all of our facilities. We've done over $250 million in transaction volume and deployed capital across 26 different investments and 41 different facilities. Our team boasts decades of experience in all aspects of the business. What we're really known for is proprietary deal flow with the partner groups that we work with. Our business model really is to acquire facilities outright, provide funds for improvements. That could even be a development, pay off debt, or even buying operating companies. So we're very flexible in our approach to finding the best investment opportunities. When looking at Birchwood's track record, I mentioned the 41 different investments that we've deployed capital to, but we've generated a 19.5% net IRR, both realized and unrealized, to our investors. So have a very strong track record that goes back to our inception, which has generated about a 2% equity multiple to our investors. So we're very proud of our track record that we've delivered to our investors. When people think about seniors, it's an interesting area. It's a very, I would say, a small and fragmented industry, which is difficult to access. At Birchwood, we have decades of relationships with industry partners. We're known for innovative deal structuring and also known as being one of the first phone calls for off-market deals that would be like a direct to seller deal. So sometimes not working through a broker, but also just working through our robust network and making sure that we have full stakeholder alignment and coordination with our partners. And really, at the end of the day, it's about coordination for risk-adjusted returns and the best clinical outcomes to the residents and patients in our facilities. So what do we invest in the 5E Plus Seniors Health? So an investment in the 5E Plus gives you access to really what we consider to be the four main verticals within seniors healthcare. You'll see the word acuity mentioned in this portfolio. We invest in seniors housing. That's where we're finding the, I would say, best opportunities today. And that would cover independent living, assisted living, memory care, and a continuum of those profiles. I think what's really helpful for investors to get their arms around kind of what we invest in is that chart at the bottom of the slide showing, no acuity versus growing acuity in care needs. We really like to kind of find that sweet spot of where we are finding opportunities in that IL, AL, and skilled nursing / traditional and long-term care investment opportunity. Traditional and long-term care is really care that is done by registered nurses, clinical nurses, where clients are in that higher acuity spectrum where they need 24/7 care, but also it's all about returning them back to their homes. You'll be some transitional care opportunities or situations there where there's some complexities where people are just released from the hospital, and you want to make sure they get the best quality of care and released. Active adult, that kind of falls into that lower acuity profile, really similar to multifamily, where really it's just programming to defeat loneliness and depression. There'll be pinochle. It's almost like living in a very large, really luxurious college dormitory where you have meals prepared or you have just things just ready for you at your will. But it's an area that we'll probably delve into later on in the investment profile of this fund. Where we're finding the best opportunities today, and Sean will talk to it, is in that senior housing space. And that would cover independent living and assisted living. And people always ask me, what's the difference between independent living and assisted living? And really what it comes down to is, in some cases, meals will be served and available to both in IL and AL, but it comes down to, the activities of daily living. With assisted living, there's going to be members in the facilities, patients in the facilities that need help with the day-to-day, whether it's bathing, just getting dressed, regular hygiene, taking medication. We cover the entire ecosystem of seniors healthcare, and we're finding opportunities really in all the different verticals, but primarily, as I mentioned, senior housing. There's one vertical I didn't speak to that we will invest in, and that's healthcare services. That's the only non-real estate element of our portfolio where it's ancillary services. That could be rehab, hospice, home health, and pharmacy, therapy, even behavioral health. Those are all services that we can plug in at the facility level. But really, when it comes down to it, this is really more of a real estate oriented portfolio. But I see this as a healthcare investment in tandem as well. I'll flip over to the next slide. So demographics. I think people read about this every day in all the different news rags. You hear about it. We call it the silver tsunami. And really what it is, it's the fastest growing age demographic in the United States is what we are investing in. So throughout the life of the 5V fund, this rapidly aging cohort is really going to boom during the fund life. And you see this hockey stick right here. That 85 plus continuum is going to grow by 2.4 million, by 35% over the life of this fund. Additionally, the 65 plus is going to grow by 31%. What we're seeing is a supply and demand imbalance because right now there just isn't enough supply to meet this pent up demand. And we're taking advantage of this. We understand that the demographics, you can't hide from demographics. And this is the fastest growing demographic in the US today. So when coming out of demographics, when people think about seniors healthcare, you think about COVID. You think about the timeline of industry distress, the age that we're just coming out of. If you look at this chart, coming out of the Great Recession of 2008, there was only 7,500 facilities in the United States, and many developed multifamily. They flooded the market with new supply. Problem was is the entrants were way too early, since this demographic wasn't, they weren't old enough yet. There just wasn't the demand yet. So you have that rapid development coupled with, and then meanwhile it doubled. You couple that with the pandemic, and that created additional industry distress. And so you have government programs and stimulus that came into play during COVID, which was really that 100-year storm during COVID. Over 270 billion flooded the market to really prop these operators and businesses up. But what we've seen is that aid closure stopped in Q3 of 2022. And what we see here is as an industry that is just coming out of distress. You have many owners and operators with maturing loans. The stimulus funds ran out. What we're seeing is just tremendous value add opportunities, and the deal flow today is just really robust. But I think what we're seeing here is demographics, distress, and today it's about demand. So we see today as the golden era of seniors housing. And what we're seeing is an acquisition cycle that's just ripe for investment. So our plan is to acquire facilities and capitalize on these value add opportunities at a lower price, drive value at the operational level, whether it's Campbell Street Senior Living, who we is our in-house operator. We'll make the operational improvements. We'll increase occupancy at these facilities into those strong demographic fundamentals that I spoke to, and then sell into future cap rate compression. We really consider that to be the superfecta opportunity. And all you really need is maybe one or two of those things to hit to really come out with a very attractive return profile in any of these facilities. So we're extremely excited about the opportunity set and the way we see the portfolio building. And Sean's going to talk to that. But what we're seeing today is that the market is already starting to improve. And I'll flip to the next slide and let Sean take over to talk a bit just about the improving fundamentals. And this is industry data that we got from Nick that Sean can talk to. And then we'll also talk about the portfolio. Sean, want to take it?
Yeah, absolutely. Thanks. So I think it's important to identify that the industry has been in a recovery mode for a while, and that we're starting to really see those strides hit. And the most common deals that we're looking at right now are deals that either took an elongated lease-up play over the COVID period because of restrictions that were in place or whatnot that has impacted them financially. But these buildings that we're seeing are coming to market now at or close to stabilization. There's still stabilization on occupancy level, still stabilization that needs to be occurred from a financial standpoint, from both revenue and expenses. But these are excellently built properties that have hit a good stride of their recovery overall, and that the market is incredibly strong going forward. And looking at the demographics that we've seen that Bill presented earlier, that there really is no end to where these properties are going to go from a stabilization standpoint. Coupled with that, development has been incredibly downtrodden over the last 5 years. So any deal that we can get across the finish line right now will pay dividends. On top of that, we have access to some of the best deals that are out in the market. So we are really setting ourselves up for success here going forward. If you want to flip to the next slide, I can talk about some of the specific deals that we're looking at here. The top deal that we are looking at right now, I would say, is in Minnesota. And this is that exact trajectory. This is a property that has been developed in 2019 and shows excellently from a stabilization standpoint, from a occupancy standpoint, but still has upside in both rent as well as on the expense side. We can come in here with our in-house vertically integrated operator and really show how this property can turn the corner and hold for the next 5 or 10 years, showing some incredible improvements on the back line and some really strong IRRs. Some of the deals that we've closed in the recent months have been a development deal, one of the only development deals that's able to get done in Minnesota on the senior housing front, at an incredibly strong price per unit. And then additionally, a transitional care facility in Iowa. That's it's a state-of-the-art transitional care facility that had a business plan in place to convert some of the assisted living units that were in it into short-term care units. So it was an incredibly strong turn on that as well. Here's some of the breakdown of that property itself. And so, by the time that we purchased this asset, which is an asset that's in the fund right now, we purchased it at $12 million, and at the closing table, we had an appraisal that said that it was worth $16.5 million. So these are some of the deals that we're seeing in the market right now that we're able to get done. Another thing that's important to note, just as far as the market itself, a lot of companies right now are still inward facing, trying to lick their wounds from the COVID timeline, and they're not being as active as they might be. So some of the playing field that we're seeing for these excellent opportunities, we're uniquely situated in order to move on these opportunities with the 5E Plus fund.
Sean, do you want to talk a bit just about the pipeline and kind of how you think about the pipeline? I know that we've received over a source of over 1,000 deals in 2023. Just maybe just a little bit about that process and how different opportunities make it into the pipeline.
Yeah, so we have a proprietary process that we go through with our point system. We have a points grading system. So when a deal comes in the front end, we immediately look at it and see how it scores on this system through a metric of about 10 items. Once it passes through that first blush, then we expand that out to about 40 more metrics that we look at that are all industry specific metrics that have been corroborated around by our in-house operator, as well as the other 100+ years of industry experience, specifically in seniors housing, that we have within our company. And these are some of the most important metrics that we have. And so that really helps us to refine the opportunities as they move through our pipeline, making sure that we are only seeing the best opportunities possible once it gets through the IC process. As far as deal flow, the most common asset that we see, like I was saying, is in that senior housing component. And while we have the ability to invest across all spectrum, and we do look deeply into every asset that comes across that we view to be a good purchase, whether that's a skilled nursing asset or a memory care or a CCRC or a continuum of care situation, we do see that the most value of right now is in that standalone senior housing community with a continuum of care from independent living, assisted living, and memory care.
Terrific. No, thank you. I think just to kind of move things along here, one thing that I wanted to point out is that this is a co-GP fund. So we mentioned Campbell Street Senior Living, and Campbell Street is our operator of choice. But there are instances where we will work with a third-party operator and management company in a geography where maybe Campbell Street doesn't have boots on the ground. And so what we'll do is we'll work in alignment with an operator of choice where there is vision, cultural, and financial alignment for future success. So these are operators that may operate, say, in Texas or in Arizona or in Utah, where we'll work with the best-in-class operator and make sure that there is space for alignment and overall consolidation. There's only 30 properties and 5,000 operators in the United States today. And operators typically struggle to acquire institutional capital due to their lack of M&A capabilities. And not only that, but just they don't have that acumen. REITs are a big player in the industry, and they work with operators, but there really is no alignment because the operator typically doesn't have any ownership of the actual real estate when working with REITs. Retail capital is also popular for investing into these types of facilities, but operators typically lack the relationships or have the investor network to find the right investors for their facilities or even potential developments in the future. So Birchwood and the 5E Plus Fund, we kind of close that gap and create that partnership with the operator to create that co-GP model where they have skin in the game and alignment, where there's shared success in the future. And that's, of course, if Campbell Street Services or Senior Living isn't the operator of choice. But for Birchwood, for us, it's all about making a lasting positive impact on seniors' healthcare. We really strive to be the investment platform of choice, and in giving investors, like you, access to what we believe to be the best opportunities. We also want to be the employer of choice. We understand that being the employer of choice in any geography is really, really important. You want to keep people in their seats. You don't want turnover. You want to pay people correctly. You want to help with tuition reimbursement. You want to create a culture where people are really excited to go into work every day. And with that, you want to be the provider of choice. You want to really instill the best of what this industry has to offer, whether it's new technology, AI, new services at the facility level to really unlock value and be that provider of choice and develop and deliver the best quality care to the end tenant or I would say patient at each facility. And then lastly, it's about making a positive impact on all stakeholder groups. If the people at the facility win, the workers at the facility win, the investors win. So it's a win-win-win across the board if we do all the right things, and that's what we strive to do on a daily basis here at Birchwood. So let's talk about the terms of the offering. So as I mentioned, the fund is we're looking to raise up to $100 million by our final closing of the strategy. You see investment size here at $500,000 as a minimum investment. Special to ET Capital investors, we are offering a $100,000 minimum to anyone that comes in through the fund through ET Capital. So we're excited to partner with ET on this opportunity and offer that capability to you all. The return profile of the strategy is an 18 to 20% net IRR to our investors. Clearly, as the sponsor, we're the GP sponsor. We have skin in the game. So up to $2 million of our own capital invested into the strategy. And as far as the fund structure, it's an 8% preferred return with a 2% management fee and a 20% carried interest. The fund term is maybe a bit longer than you may be used to seeing when you invest in one-off deals or just direct deals. The fund term here is 8 years from the final close with 2 one-year extensions. So potentially a 10-year time horizon. With that being said, what you're doing is you're getting access to a number of deals. We're talking a couple handfuls of deals in the senior space, which we consider to be the best deals that we believe will deliver very positive results and cash flows after recapitalizations and exits. And the typical timeline of an investment in the fund is anywhere from 5 years to 7 years. So for us, it's all about returning capital and distributing capital back to our investors as soon as we can. And the investment period, and that's for us, is after our final closing, we have 3 years to deploy the capital to the investors with a 1-year extension. And so this is a capital call structure, meaning is, say if you fill out paperwork for the next closing, we'll call capital based on the amount of capital that we need to fund different investment opportunities that we're looking at. So that may have, you may have completed paperwork, and we may make our first capital call sometime in May or June. So just to give you just a bit of a understanding of the timeline, just because the closing's on April 19th, we may not call capital until late May, sometime in June. And then as far as distributions are concerned, 100% of all distributions go to investors until an 8% return, plus all capital and carried interest is returned to the client. So clients, investors, LPs, they get paid first. So just wanted to close with those terms. And before I turn it over to Eric, just a little bit about the team here at Birchwood. And I'll send a copy of this or you'll actually, Eric will have a copy of this to send to everybody that wants to dig into the bios. But our firm was founded by Isaac Dole in 2014. So he's our founder and CEO. He spent his entire life in seniors and really started Birchwood after being the senior managing director of acquisitions at a very large REIT, Aviv REIT, based here in Chicago. We have Brenda Satterfield, our CFO. She has decades of experience in this space. Sean, who's on the line on this call, he too has a bounty of experience in seniors and specifically seniors since he started his career over 20 years ago. We are supported by an advisory board who span I would say, a large deal of experience across hospital systems, private equity, nurse practitioners, businesses, private equity, you name it. But we have a group of experts that really help guide our path and how we want to deliver success to all stakeholders here at Birchwood. And then finally, I would be wrong in not mentioning Campbell Street Senior Living, which is our in-house operator. They were founded in 2018. So we talk about real estate, we talk about the facilities, but really it's about unlocking value and really delivering the best quality care within those facilities. And Campbell Street Services is a huge foothold in the state of Iowa. We actually manage 8 of our 12 communities in Iowa. We have management in Minnesota, Kansas, and Georgia. But we have 505 employees in Iowa, and we serve 453 residents at our facilities in the state. And really proud to say that we've discharged over 225 residents back into their homes in the state of Iowa. So they've been very successful. It's an award-winning operator, and we'll utilize Campbell Street Services any opportunity that we can because it's boots on the ground. They're our partner firm. We own them, and we are excited about their growth as this fund grows. But with that, I'll close things up on this deck, and Eric, would love to answer any questions that you might have.
Well, yeah, thank you very much, Bill and Sean. I appreciate the information, and you guys went through this very well. There's not a lot of questions. There were a couple of questions at the original when you did this in Des Moines, and I can't remember what those were. So unfortunately, but I have these ones that. Can you explain a little bit about the difference between being a general partner, the GP, as opposed to being an LP? Because in my projects, people have always been LP, been on the limited partner side. And when it's been the general partner is always, something that I've seen as the one who is responsible for, any guaranteeing of debt and that sort of thing. So I was just wondering if you could, I know on yours, that's not the case. So I was wondering if you could just explain that a little bit.
Sure. I can take that if you don't mind. So this is a GP fund. So when you invest in the fund as an LP, so you'll see that an investor is coming in as an LP into the 5E Fund Plus. 5E Plus fund. When we deploy capital as Birchwood and the fund into a deal, we're investing into a deal as the GP. And so as the GP and at each deal and each investment opportunity, we sit at the top of the capital stack. We are actually structuring the deal. We are structuring, all elements of it. The lenders that we deal with, we're talking to the owners. We're getting licensure. We are really building out the economics of the deal. And so sitting in that GP seat, it improves the overall economics of, kind of at the end of the day, when you exit, the GP typically gets a pretty good slice of the economics. So when looking at, you call the waterfall, you sit in that front seat, so to speak, as being the GP. And then what you have is the debt. So you have the GP, which is Birchwood and the fund investors as the 5E plus fund. Then you have the debt, which we source as well. So Birchwood sources the debt. And then Birchwood's also responsible for sourcing the LP equity for each deal as well. By sourcing LP equity, we are working with institutional investment partners that will fund the LP component of that stack rather than syndicating it out person by person. The deals that we're looking at and the opportunities, I like to call them opportunities that we're looking at, tend to be on the larger side. And so there's institutional investors out there that typically look at having programmatic relationships. And a programmatic relationship would be where not only do they like what we're doing in Minnesota, they might like what we're doing in Texas and also in Utah. And they've kind of agreed to work with us as being that LP provider, equity provider across all those deals. Meanwhile, the fund investors come in at the top of the stack alongside with Birchwood. I hope that makes sense.
Yeah, that's great. And one of the slides you talked about a 1.96, basically a 2 times equity multiple.
Yes.
And what's the time period of that?
Sure. So that 1.9 equity multiple is for our track record of previous investments going back to 2014, and some of those are unrealized, but we value on a quarterly and semi-annual basis.
But so, I mean, what I'm asking, I guess, is what time period does it? Are you saying was that?
Oh yeah. So our average holding period, typically between 5 and 7 years, similar to what we're doing with the fund.
So is it a 5-year or a time period that you get to a 1.96? Is that what?
It will, yeah. It all depends on the actual investment. So it could be one could be 5, one can be 7. And what we're doing is we're just aggregating our entire track record historically, and what have we delivered to our investors in the 10 years since we've been in business. And some investments, we haven't sold because you don't want to sell at the wrong time. Similar to anything else, you want to make sure that the environment is optimal to exit.
Okay. Are you guys have grown pretty significantly. What's your long-term plan? I mean, do you guys have plans of going public, or what?
No, nothing immediate. I think what's important to us is to have smart growth. Really grow this fund and really build what we consider to be a well-diversified portfolio over this investment period. I think maybe sometime later next year, we'll probably have a fund too. And we're going to continue to better understand the opportunity set as the markets change. But what we see today, we haven't seen anything better in the history of our entire investment history. We think that this current environment is the best. The next, I think, 6 to 12 months are just super important to deploy capital, because what you're going to start to see is institutional capital, people coming from multifamily apartments that are looking at diversifying their portfolios and come into the space, and then you're just not going to get it at that basis that you once could have, today. Yeah, but I would say calculated, smart growth. No plans to go public anytime soon.
So, great. I get that. What about are there any ways, you and I have discussed this, but just it's an 8-year term with 2 1-year extensions. So there's no way to get out of this project in, say, 4 years. I mean, you're locked into a project for.
Right. I mean, so what you're doing is we are we're a fund manager, so we have the discretion to find what we believe to be the best opportunities as the general partner alongside with the investors in the fund in each deal. Our time horizon is typically between that 5 to 7 year period, and trying to say, hey, in 4 years maybe you can get out. I think if there's an opportunity where someone's like, look, I do need to exit, we can consider it, but we have not built it into our base case because there is no mechanism for us to purchase people's ownership interests. We're really not planning on that. I mean, we come and go, and I look at this as a medium to long term play into the seniors healthcare space, into participating really in a great opportunity where you're looking at generational wealth creation.
All righty. You mentioned capital call at one point when you were talking about the deployment of the funds, and the capital. And, I think for most of my clients, capital call is something I always tell everybody, you're never gonna hear a capital call. Then that's because they're not ever guaranteeing any of the debt. But your capital call means a little different thing. So I thought maybe we could go into that just a little bit more.
Yeah.
A little
Yes.
deeper.
So right now, and Sean spoke to a couple of the opportunities in our pipeline. There'll come a time where we'll need to fund the equity to make those acquisitions. And when it comes time to fund the equity to make those acquisitions, we'll issue a capital call. And so when a client signs up for the fund and completes their subscription documents, reviews the legal docs, they're not writing a check that day. But there will come a time where it's like, okay, we're ready to close on this opportunity potentially here in Minnesota or in Texas. And to complete the acquisition, we're going to need X amount of capital that we'll need to call by percentage of ownership interest for each client. So, and not only that, but we have to give each investor 10 business days prior notification that the capital call is coming. So it's not like we're going to call and say, hey, we need this tomorrow. There's going to be time, and rest assured, if we're even in that seat where we know things are on the horizon, we'll let you know well before 10 days that this is what we're thinking, so people can be prepared to deploy the capital, and then we can invest it to close on acquisitions.
And so obviously the most you would ever be asking for when you ask for that capital call would be whatever they've committed to for their investment.
That's the limit. Exactly. That would be the limit.
Project.
Yeah. It couldn't go more than what they've already committed.
Right. Perfect. And then, so if this fund closes on 4/19 of 24, I think is the date you mentioned. And yes. How long could it be before, what's the longest time period somebody could have before you would ask for that capital or have a capital call for them?
Sure. I would say I would say just based on our current pipeline, it'd probably be about a month and a half, 2 months. Sean, if would that make sense?
Yeah, I think that makes sense. And I don't know that would be calling the entire amount as well. That could be a portion of it. But yeah, that's about right with our timeline that we're looking at right now.
Oh, is there something to do with the fund that says that, like you couldn't ask for money, like say they did it 4/19, do you have to have all those funds committed by a certain date? Or is it, like it couldn't be 5 years into the fund and they haven't had to contribute anything. And then all of a sudden you're like, all right, we're ready for your $250,000 today.
Yeah. So our investment period is 3 years after final closing. So okay. The way we're looking at opportunities today is that there are so many great opportunities is that I can see us deploying capital sooner than later and putting capital to work sooner than later than sitting on opportunities. And and meanwhile, it's not like we're sitting on cash that clients allocate our way. The capital that we call is going to go directly into completing an acquisition, and we'll understand how much is needed. But I would say that we do have flexibility. It could be 3 years plus that 1 year extension to invest the capital. But based on the opportunity set that we see today, I see it. I see us funding deals sooner than later.
Okay. And once the capital is called, it's not returned at any time. It's not returned if a project then sells within the fund. Is any capital returned that would then be asked for again in another capital call, or is once the capital is called, it's in the system and it's working and it doesn't come back until it's actually returned as returns?
Correct.
Okay.
You're right. Yes.
All right.
We're not going to recall capital that's been returned.
Right.
Those
right.
are
Right.
that's the return that we've generated for the investor, and
Right.
that's
Then the capital's returned at the closing.
That's the client's capital. Yes.
Yeah, and then the capital would be returned at the final closing of the entire fund.
Absolutely. Yep. At the latest 10 years, everything, the fund needs to close and all capital returned at the latest in 10 years, 8 years at the earliest. So we need to start working on dispositions really going into that year 8, year 9, ensuring that we exit everything by year 10 at the latest. So, but yeah, so just to kind of give it an idea of when clients can expect to return their, not just their money back, but also really the big chunky stuff is when we make the exits. Because for instance, if you think about our Iowa portfolio that we spoke to out in Ankeny, there'll be a recapitalization event that we're forecasting or pro-forming year 3, and then maybe an exit year 5. And then, clearly there'll be distributions. We got to pay our pref to the client. So clients will get, the preferred return, but those big returns come upon recapitalization and full exit. Am I correct on all fronts there, Sean?
Yeah, I think it's just important to highlight that, so that in line with what you were saying, that there will be lumpy capital distributions that come out that exceed the pref throughout the life of the fund. It's not any necessarily set schedule, but it could be, year 3, we go through a refinance, boom, then there's a big check that would go out to through distributions, or, when there's a sale, we modeled something for year 5 where we get an incredible offer on an asset, and then that happens, then there would be a distribution at that point, in addition to the closing of the fund where everything would be dissolved at that point and returning of original principal.
After the oh shoot, I had a really good question. Now I just totally forgot it. Oh well. All right, I guess that was one I just thought up, but that was all the questions I had written down. And are there anything I'm missing that I should be asking? I don't think I'm,
No, I think you asked a lot of the right questions. I think the important thing is understanding the mechanics of how a fund works versus investing directly into a deal. And I think the advantage of this portfolio is that you're getting a well-diversified package, so to speak, of outstanding opportunities across the entire seniors healthcare and real estate ecosystem. Additionally, I think the mechanics of how the capital is put to work is just really important to understand. Is that we're going to be selective and timely in letting our investors know when capital needs to be called, and there'll be rationale that we deliver to as to what we're using that capital for. But no, you asked very, very good questions as it relates to the mechanics.
And as long as we're talking about it real quick, you guys have already closed on the project, the long-term care center, long-term recovery center in Ankeny, and you have already shared some good information about that. It sounds like it's already doing a little better than projected. Is that the case?
It is. Sean, do you want to provide a bit of an update?
Yeah, absolutely. Like I mentioned, the most glaring one is that our purchase price versus where the actual valuation was at close. It was a $4 million pickup in valuation there. But since we've taken over the keys, we've beat our original projections every single month that we've had, so January and February. And then in addition to that, our census has been well above. We originally projected it to be about 85%, and we have been averaging in that 95% range, with it being well over that at many periods in time, and that what's called the quality mix, meaning the payer mix. There's many different payer sources in a community like this, and we've been beating the projected numbers for the private pay residents, and also billing incredibly well and getting a higher reimbursement rate than what was originally projected. So we're really beating every single metric that we originally projected out, and that still has yet to come with some of the Campbell Street Senior Living normalization of expenses that will come as a large operator in the market. So we will see further expense reduction as we're going forward over time.
Great. So that's good.
And then the other asset that we're also invested in right now, the Minnesota development, is on time and below budget currently, which will be opened later this year. And that one's also tracking incredibly well.
Awesome. Well, that all sounds great. Hopefully we will be sending you a lot of funds from ET Capital Partners clients.
Well, we appreciate the opportunity, and we understand that making investment decisions is important, and we welcome any follow-up questions, and look forward to future conversations with the ET Capital investors, and of course you too, Eric. And one thing that I just wanted to note is that it's always important to get paperwork and things like that organized well before we go into a closing, so that way we understand how much capital we have put together to deploy going into into the end of the closing. So we'll be there, you lock, step, and foot, to make sure that we get everything taken care of and answer all questions that investors that you have as you go through the process of reviewing this strategy. And we just really appreciate the opportunity, and we think it's a great one, and we're excited about the partnership.
Well, thank you guys very much.
Thank you.
Thank
You
you.
guys have a wonderful night.
You too.
You
Take
too.
care, everybody. See you.
Thank you.
Bye.